Hey there. Welcome to the North Florida VA Real Estate Podcast. I'm Darian's avatar, the voice he sends out when he's juggling everything else, researching properties, reviewing contracts, pulling a hospital shift, or sitting at karate practice, pretending he's not the one getting nervous. Right now, he's probably on the golf course explaining how that slice was intentional shot shaping. Today, we're talking about something that can rattle even the most disciplined buyer, a low appraisal. Episode 29, the appraisal gap game plan. Winning when the value falls short. Low appraisal? Don't panic, because this moment does not mean you lost. It means the negotiation just changed. And if you understand how the game works, you can still win. Let's paint the picture. You're under contract. You fought through multiple offers. You wrote strong terms. You feel like you secured the house. Then the appraisal report hits your inbox. The value is lower than your contract price. Immediately, your brain jumps to worst-case scenarios. Did I overpay? Is the deal dead? Am I about to lose my deposit? Slow down. Let's strip this down to math. You agreed to buy at $400,000. The appraisal says $385,000. That's a $15,000 gap. With a VA loan, the lender bases the loan amount on the appraised value, not the contract price. So they're lending off $385,000, not $400,000. That difference must be resolved. That's it. The appraisal gap is simply the difference between what you agreed to pay and what the appraiser believes the home is worth based on recent comparable sales. No drama, just numbers. But numbers feel emotional when they affect your future. I worked with a Navy veteran last year, confident, strong income, clear long-term plan. He found a property in a competitive neighborhood. We knew it was tight. We knew it would be aggressive. We won the contract. Then the appraisal came in $12,000 low. His first reaction was frustration. I knew this was too good to be true. It wasn't. It was just the next phase of the deal. That's the first mindset shift I need you to adopt. A low appraisal is not a failure. It is a negotiation trigger. Now let's walk through your options calmly and strategically. Option 1. Renegotiate the purchase price. This is the most common path. You present the appraisal report to the seller. You explain that the lender cannot fund above appraised value, and you ask for a price adjustment. Here's what most buyers don't realize. If you walk away, the next buyer will likely face the same appraisal issue, unless they are bringing large cash reserves. Sellers understand this. In many cases, they reduce the price to the appraised value or close to it, not because they're generous, because it's logical. Real estate is supply and demand, but it's also data-driven. If the data says $385,000, that becomes a negotiation anchor. Option 2. Split the difference. This is extremely common. Using our example, $15,000 gap. Seller lowers the price by $7,500. You bring $7,500 to closing. Both parties compromise. This preserves the deal. It protects relationships, and it feels balanced. But this option requires preparation. You need liquidity. Here's something veterans need to hear clearly. Zero down does not mean zero reserves. Just because the VA loan allows you to buy without a down payment does not mean you should operate without financial cushion. Strong buyers have options. Weak buyers feel cornered. Options create leverage. Leverage wins negotiations. Option 3. Bring the full difference in cash. Now, before you reject that idea, think strategically. If you plan to live in the property long term, if the neighborhood is strong, if appreciation trends are solid, that $15,000 may not matter in 5 years, but this must be a calculated decision, not an emotional attachment to granite countertops. Ask yourself this question. If I step back and look at this purely as an investment, does it still make sense? If the answer is yes, bringing the difference might be smart. If the answer is uncertain, slow down. Option 4. Request a reconsideration of value. With VA loans, this process is structured and specific. If there are factual errors in the appraisal report, or if strong comparable sales were missed, you can submit those through your lender. This is not about arguing feelings. This is about presenting better data. Maybe a similar home closed 2 weeks ago at a higher price. Maybe square footage was miscalculated. Maybe upgrades were undervalued. If the evidence supports a higher value, you have grounds to push back. I've seen this work. Not every time, but enough times to matter. Option 5. Walk away. Yes, sometimes that is the win. If the seller refuses to negotiate, if bringing cash drains your emergency fund, if the numbers no longer align with your financial plan, walking away protects your long-term stability. Veterans understand mission discipline. You do not advance into a bad position just because you already moved forward once. You reassess, you reposition, you protect your resources. Now let's talk about something unique to the VA loan process, the Tidewater Initiative. If a VA appraiser believes the property may not meet the contract value, they are required to notify the lender before finalizing the report. This creates a short window of opportunity. During that window, you can submit additional comparable sales to support the contract price. This window matters because once the appraisal is finalized, flexibility decreases. An experienced real estate team watches for Tidewater notifications closely. They respond quickly. Speed matters. Preparation matters even more. Here's a critical truth. Appraisal strategy begins before you write the offer. Let me say that again. Appraisal strategy begins before you write the offer. When evaluating a home, you should already be reviewing comparable sales. You should already know the average price per square foot in that neighborhood. You should already understand whether the contract price can be justified. If you're offering above the most recent comparable by $20,000, you are increasing appraisal risk. That doesn't mean don't do it. It means understand the risk before committing. I worked with an Army veteran couple in a fast-moving market. Inventory was low. Multiple offers were common. Before submitting their offer, we analyzed every sale within half a mile over the last 6 months. We calculated price per square foot. We adjusted for pool versus no pool. We adjusted for renovated kitchens. When the appraisal came in $5,000 low, we weren't surprised, but we were prepared. 2 comparable sales had just closed slightly higher. We submitted them immediately through Tidewater. The value was adjusted upward. Deal saved. That wasn't luck. That was preparation meeting opportunity. Now let's address the emotional reaction. Low appraisals feel like rejection. It feels like someone is saying, "You overpaid," but appraisers rely on closed sales. Closed sales reflect past data. In rapidly appreciating markets, contract prices can outpace closed data. There can be a short lag. That lag creates appraisal gaps. Understanding this prevents panic. Instead of reacting emotionally, ask yourself a better question. What does the broader market data say? If multiple properties are going under contract at similar prices, the market may support your number. If not, the appraisal may be protecting you. Appraisers are not the enemy. They protect the lender. And indirectly, they protect you from overextending financially. Another common fear I hear is this: will I lose my earnest money? In most VA contracts, there is an appraisal contingency. If the property does not appraise, you typically have the right to renegotiate or withdraw. But deadlines matter. You must respond within the contract timeline. Communication must be clear. Silence creates risk. When appraisal comes in low, you do not disappear. You gather data. You consult your team. You decide strategically. Let's talk about something deeper: pride. Pride destroys more deals than low appraisals ever will. Buyers sometimes think, "I already told my family we're getting this house," or "I don't want to look weak asking for a price reduction." This is not about pride. It is about wealth building. You are not trying to win an argument. You are trying to make a sound financial decision. Those are different objectives. If the numbers no longer align with your long-term goals, you adjust. That is strength. Now here is your tactical framework when facing a low appraisal. Step 1, pause. No emotional reactions. Step 2, review the appraisal report in detail. Look at the comparable sales used. Look at adjustments made. Step 3, calculate the exact gap. Know the number clearly. Step 4, evaluate your cash reserves honestly. If bringing the difference leaves you exposed, that matters. Step 5, assess renegotiation probability based on market conditions. Is inventory high or low? Is the seller motivated? Step 6, make a decision based on long-term math, not short-term emotion. The goal is not just to close this deal. The goal is to build wealth safely using your VA benefit. A low appraisal is not a verdict. It is a checkpoint. Sometimes you push forward. Sometimes you renegotiate. Sometimes you disengage. But you always decide from a position of clarity. Because the veteran advantage in real estate is not just the loan product. It is discipline. It is strategy. It is thinking 3 moves ahead. In the next segment, we're going to go deeper into how to structure your offers to reduce appraisal risk from the beginning. We'll talk about appraisal gap clauses, we'll talk about competitive market tactics, and we'll talk about how veterans can compete aggressively without gambling their financial future. Because buying a home is not just about getting keys, it's about positioning yourself for long-term stability and growth. And that requires a plan, not panic. All right, let's get into the real strategy. Now we're talking about controlling it. This is where veterans win, not by reacting, by preparing. If you want to compete in today's market without gambling your financial stability, you have to think about appraisal risk before you ever submit an offer. That's the shift. Most buyers fall in love with a house first, then they think about value second. We reverse that. Value first, emotion second. Let's talk about structuring the offer correctly from day one. When you're preparing to submit an offer, you should already know 3 things. Number 1, what are the most recent comparable sales? Number 2, what is the average price per square foot? Number 3, is your offer supported by closed data? If you cannot confidently answer those questions, you are guessing, and guessing is expensive. I worked with an Air Force veteran who wanted to be aggressive in a multiple offer situation. The listing price was $400,000. He wanted to offer $415,000 to win. Before we did anything, we studied the comps. The highest recent sale in that neighborhood was $405,000. Offering $415,000 created immediate appraisal risk. Could the market be moving upward? Maybe, but there was no closed data to justify it yet. So instead of offering $415,000 blindly, we structured the offer differently. We offered $410,000, but we included a structured appraisal gap plan. Now let's talk about appraisal gap clauses. This is a powerful tool. An appraisal gap clause essentially tells the seller ahead of time how you will handle a low appraisal. It reduces uncertainty for the seller, and sellers love certainty. For example, you can write into the contract, buyer agrees to cover up to $10,000 of appraisal gap in the event the property appraises below contract price. What does that do? It tells the seller you are serious. It tells the seller you won't immediately walk if the appraisal comes in slightly low, but it also sets a ceiling. You are not writing a blank check. You are defining your risk tolerance. That is strategy. Another structure is this: offer strong price, short inspection period, flexible closing date, but maintain the appraisal contingency intact. Why? Because appraisal is where financial discipline lives. You can be flexible in timing, you can be flexible in minor repairs, but you do not compromise valuation discipline. Now let's talk about competitive markets. In hot markets, appraisal gaps are more common. Why? Because buyers are bidding based on emotion and scarcity. Appraisers are valuing based on closed sales. There is often a gap between those two. So how do veterans compete without overexposing themselves? Here's one tactic: strengthen the offer in non-price ways. Price is only one lever. You can increase earnest money. You can offer quicker closing. You can reduce minor contingencies. These tactics make your offer attractive without artificially inflating price beyond supportable value. I had a Marine Corps family competing against a conventional buyer who was putting 20% down. The seller was nervous about VA financing. We knew the appraisal might be tight. Instead of escalating price dramatically, we focused on certainty, strong earnest money, clear timeline, lender fully underwritten up front. We demonstrated strength. The seller accepted our offer over a higher priced one because we reduced perceived risk. That's how you compete smart. Now let's talk about something critical: cash reserves. If you are entering a competitive market with zero reserves, you are already vulnerable. I know the VA loan allows zero down. That is a benefit, but benefits must be handled with discipline. If an appraisal gap of $5,000 or $10,000 would financially cripple you, you are too thin. Real estate should not create anxiety. It should create stability. Here's a rule of thumb I give veterans. Before going under contract, ask yourself this question: if I had to bring an extra $5,000 to $10,000 unexpectedly, could I do it without stress? If the answer is no, slow down. Build reserves first. Strength gives you negotiation power. Weakness forces bad decisions. Now let's revisit the Tidewater process in more detail. When Tidewater is triggered, time is limited. limited. You usually have a short window to submit additional comparable sales. This is not the moment to scramble randomly. Your agent should already have a list of backup comps ready. I've seen buyers lose leverage because they waited 2 days to respond. Speed matters. If you can submit strong comparables quickly, you increase the chance of adjustment. But let's be clear, not every appraisal can be fixed. Sometimes the value truly is lower, and this is where discipline separates investors from emotional buyers. If the data does not support your price, forcing the deal rarely ends well. I once worked with a veteran who was determined to close no matter what. Appraisal came in $20,000 low. Seller refused to budge. He brought the full gap in cash. 2 years later, the market softened slightly. He needed to relocate. He had little equity because he entered at the top. It wasn't catastrophic, but it limited flexibility. Contrast that with another client. Appraisal came in $12,000 low. Seller would not negotiate. Client walked away. 3 months later, a similar property in the same neighborhood came available. Listed lower, appraised clean, closed smoothly. Patience paid off. Sometimes walking is not losing, it's positioning. Let's talk about psychology for a minute. When you go under contract, you mentally move into the home. You picture your furniture, your family gatherings, your routines. That emotional investment makes it harder to negotiate rationally. This is why you need a framework. When appraisal comes in low, return to math. Is the long-term value still intact? Does the neighborhood support appreciation? Are you protected financially? If yes, proceed strategically. If not, adjust. Now let's discuss seller dynamics. Not all sellers respond the same. Some are financially flexible. Some are emotionally attached. Some need to close quickly. Understanding their motivation helps negotiation. If the seller already purchased another home, they may need this sale to close. That increases your leverage. If the seller owns the home free and clear and is not in a rush, leverage decreases. Strategy is situational. This is not one size fits all. Now I want to address a misconception specifically for veterans. Some believe that because it's a VA loan, sellers will not negotiate. That is outdated thinking. The VA loan is strong, low default rates, backed by the government. The appraisal standards are strict, yes, but strict does not mean weak. It means protective. And protection is good when you are building long-term wealth. Another tactical move. If appraisal is slightly low, sometimes you can adjust seller concessions instead of price. For example, reducing closing cost credits while adjusting price accordingly. Creative structuring can sometimes bridge smaller gaps. But always review with your lender. Every dollar matters in underwriting. Now let's zoom out. Why does all of this matter so much? Because your VA benefit is one of the most powerful wealth-building tools available to you. You can buy with zero down, no mortgage insurance, competitive interest rates, but power without discipline becomes risk. Your goal is not just to buy a house, it is to build equity. Equity builds options. Options build freedom. Freedom builds stability. A low appraisal is simply part of the process. It is not a threat, it is a checkpoint, and veterans are trained for checkpoints. You assess, you adjust, you execute. Here is your full appraisal gap game plan summarized. Before offering, study the comps. Understand price per square foot. Assess appraisal risk honestly. While offering, structure intelligently. Use appraisal gap clauses strategically. Strengthen non-price terms. If appraisal comes in low, pause. Review data, evaluate reserves, negotiate calmly. Consider ROV if supported. Decide based on long-term math. Not ego, not fear, not pressure. Math, because the mission is not emotional satisfaction. The mission is financial strength. And sometimes strength means pushing forward. Sometimes it means compromising. Sometimes it means walking away with confidence. If you're listening to this and currently under contract, take a breath. You have options. If you're preparing to buy, prepare properly. Study before you strike. And if you're unsure how exposed you are in your current situation, talk to a professional who understands VA financing deeply. Do not navigate appraisal gaps alone. This is where experienced guidance matters most. Now, here's your action step. If you're even thinking about buying in the next 6 months, start reviewing neighborhood sales now. Watch the trends. Build reserves intentionally. Position yourself so that when opportunity comes, you are strong, not scrambling. And if you're already under contract and nervous about appraisal risk, reach out. Let's evaluate your exposure before the report hits, because strategy beats surprise every time. If this episode helped you, share it with another veteran who is house hunting right now. Too many service members lose deals or overpay simply because they didn't understand the mechanics. Education creates leverage. Leverage creates wins. And wins create long-term wealth. As always, everything you ever wanted is on the other side of fear. The Florida Veterans Real Estate Podcast is brought to you by Exit Inspired Real Estate. All information is for educational purposes. Consult a professional before making financial decisions. Equal housing opportunity.